All right, we're live and recording.
Is my sound okay, Courtney?
Yep, sounds good. Your screen looks good too. Do you have your light on?
I do.
Okay, cool. Yeah, so if they haven't already sent their information for the CE credit, you can tell them to go ahead and send it and I'll add them to the list and I'll be checking during the event to make sure they stay, and I can run the report after.
Yeah.
All right, I'm turning my camera off, but I can still hear you and everything. So if you call out for me, I'll be here.
Okay. Jason, unshare your screen though.
Oh, okay.
I'm going to speak first. I'm going to go ahead and.
Darel, be sure to remind them that it is for Texas licensed realtors only, because I have gotten people that have asked for different states.
Okay. Are you going to start a meeting here pretty soon?
They're all in. There's already 30.
Oh, okay, good.
Like they're just coming in on their own for the webinar.
Okay, perfect. Hello, everyone. We're going to give everybody a few minutes to get on. Normally start about 5 minutes after 1, but thank you for joining us. Courtney,
Yep.
check your text.
2 more minutes and then we can get started.
Get started in just another minute, guys. It's so weird not having everybody on a regular Zoom where I can see their faces. If you guys have questions, just so you know, there is a chat box if you've never been on one of these Zoom webinars. On the bottom, if you scroll, there's a little icon that says chat. If you click there, you can type a question in. JB, you still there?
Yeah, I'm here.
Okay, good. All right, I guess I'm gonna go ahead and get started. Get my screen up. No, that's not right. There. Okay, welcome everybody. My name is Darel Daik. I am the owner, founder, CEO of Noble Mortgage and Investments, and you are attending our webinar. So if you haven't been to one of these before, again, you can use the chat box to ask any questions along the way. You can also verbally ask questions if you prefer, but let's wait to receive those until after the presentations are done, or after each presentation is done. I'm going to be covering financing, and then my friend Jason Bible is going to chime in about how to invest in a post-COVID world. So sit tight. We have a lot of great information to share with you guys. So it's first talking on the financing side and then moving on to JB after that. If you are a Texas realtor, keep in mind Texas realtor, because I think we do have some people that are attending that are out of state, and you would like to receive a continuing education credit. If you haven't already done so, then send an email to this email address, events@noblemortgage.com. We need your first and last name and your Texas real estate license number, as well as a copy of your driver's license, and you can receive a 1-hour credit for this class. So that's good. You can learn something as well as get some free continuing education. So events@noblemortgage.com. Send those to that email address, and Courtney will get you squared away. You do have to be here during the entire class, at least my portion. Jason's is not a CE credited course, but mine is, so you have to stay for the entire class. Just a little bit about Noble Mortgage, if you're not familiar with us. We have been in business since 2003, so 17 years in business. Collectively as a team, we have over 50 years of mortgage experience. We do hard money conventional. We also have bank programs, no income documentation programs. We do both residential and commercial lending. And really what sets us apart is our customer service. We offer a 5-point guarantee that just has to do with customer service items. And we really, really believe in doing that. If you look at our Google reviews, you'll see that we have, I think we're like 230 or 240 total reviews, all of them which are 5 stars. So we really work hard at keeping our customer service at a very, very high level, which is not easy to do, but it's something that we like to focus on. So this class is really built for beginning investors and some seasoned investors as well, if they need to get caught up with what's changed and so forth, but mostly for beginner investors. And what I always like to tell investors as you're first starting out is you need to learn how to finance things. If you're going to be in real estate, you need to learn how to borrow money, whether it's from your parents, from your friends, from your local banker, from a hard money lender, from a private lender, you name it. You have to learn how to put the money together, because the hardest thing in real estate is finding the deal, Finding the deal is always the hardest part. After you find the deal, there's plenty of lenders out there. You can find someone to appraise it. You can find a realtor to help you find it, all that kind of stuff. But you have to be able to put the money together on it. But finding the deal is the hardest part. So you have to understand the different types of financing, because not every single deal works with the same type of financing. Some transactions only work paying cash or using hard money. Some transactions, will only work on a conventional basis if you need long-term money. So you have to learn how all the different types work together and then match that with that particular deal. So today we're going to be talking about residential only. We're not going to get into commercial. If you have a question on commercial, I'll be happy to answer it, but just put it in the chat box for now. So we're going to talk about flipping houses and also holding properties for long-term rental income. So how to understand the different types of real estate financing that is available. There's really only 4 options other than private money, which I don't cover private money. Private money is just really borrowing from an individual that has a bunch of cash to lend out, and those lenders are readily available if you know how to find them. But today we're going to talk about hard money, conventional products, portfolio and or blanket loans, and also what we call non-QM or no income documentation loans, which have been really, really popular the last several years. So first of all, we're going to talk about hard money. So what is hard money? Hard money is really, people have always said it's an asset-based loan. And I like to use the term value-based loan because, when I first started in the industry back, I don't even want to date myself that far, but probably in 1996, there was no value-based loan. It wasn't based on the after repaired value like it is now. It was all based on what the property was worth as is. So that has changed. That model has changed. And now we look at not what the property is based on right now, not the asset, what it's worth, and we can do that. But if you're adding value to it by fixing it up or updating the finishes and so forth, then we take that into account. So we base it off of what's called the ARV or the after repaired value. These are short-term loans, typically 6 to 12 months. So it's not a permanent solution for whatever it is you're trying to buy. One of the biggest benefits is you can get up to 100% financing on a residential transaction. So that's huge. That's really the main benefit. 100% financing and also closing very, very fast. Hard money typically closed in about 7 business days. We've actually closed a loan in 1 day before. So you can move very, very quickly as long as you have some of the due diligence, already done. Let's say the title's done and so forth. That normally what takes the longest at least. So hard money, these are loans built for investors looking to flip and or build a rental portfolio without putting down 20%. So let's talk about what's changed first since COVID. So hard money lenders are very similar to your local bank in that everyone is different. There's no standardized lending like there is on the conventional side. So each and every hard money lender is going to have a different set of criteria. There's some generalities that most of the hard money lenders follow, but everybody has a different approach. And so one thing I've learned, I keep up with all my competitors and a lot of them are friends. Most of the hard money lenders, first of all, when the shutdown first hit in March, a lot of the lenders completely stopped lending. They went 100% shut down. And some of them have not reopened, and they decided that they wanted to wait and see what happened. We stayed open. We kept lending. Although we changed our guidelines a little bit, we took a little more conservative approach. For a short while there, we were requiring 10% down and so forth. And so that's changed. We went back to our normal 70% up to 100% financing. Although we do like to see a little bit more cash reserves. I think there's still some concerns about the economy, what's going to happen next year. We're in an election year right now. I know me from a personal standpoint, I'm a little bit concerned about 2021, what we're going to see. I think there's been a lot of money that's been pumped into our economy. And so I think we haven't really felt the recession yet because there's a lot of SBA money for businesses. So that's kind of helped keep a lot of businesses open. And I think when that dries up in 2021, I think eventually that could have an effect on our market. I think we might see some foreclosures spike, especially on the commercial side, possibly in the residential. So I'm wait and see approach right now. We're still doing 100% financing, but we do like to see that our customers have a little more cash reserves just in case it does take them a little bit longer to sell the property or something happens in the economy. Everything right now is pointing to a very, very healthy market in Houston and Texas in general. So right now we're very, very optimistic about what's going on. So again, why use a hard money loan? All about leverage. You can get up to 100% financing and close very, very fast. Again, 1 to 10 days. You know, in this market, we have a very, very low inventory right now. So if you do find a deal, you better be able to close very, very quickly. So going through a regular conventional loan, which right now, conventional loans are taking all of 60 days. I mean, we used to be able to get them done in 3 or 4 weeks. And that is very, very difficult to do right now. The lenders are just completely bombarded because the rates have been so low. And so submitting a loan can take normally about 60 days right now. It's very frustrating from our standpoint as well as a customer standpoint. So you need to allow that time. But as hard money loans, again, we make our own rules so we can close these deals very, very quickly. Again, typically we like to tell people about 7 business days or 10 days total. If you have some of the due diligence done like title and you got a rush deal, we can certainly close it a lot quicker. Types of clients hard money would benefit. Again, investors are looking to flip houses. Conventional lenders don't want to lend to an investor that wants to flip the house. They want that loan to remain in their portfolio for a minimum amount of a year. If you pay off a loan on a conventional basis in less than a year, then it's probably going to cause you issues. You're going to probably having trouble getting another loan because back in the old days, you know, in the 90s and early 2000s, the lenders didn't really communicate with each other. Well, that's changed ever since the Great Recession in 2008, 2009. The lenders have created a system where they all communicate with each other. So if you're using a conventional loan and then paying it off and using a conventional loan and paying off, the other lenders are going to figure this out very, very quickly, and they're going to stop lending to you altogether. So you need to pay cash or go with a hard money lender. Investors looking to build a rental portfolio that don't want to put down 20%. Again, if you go the conventional route, you have to put down 20% of purchase price. They don't care what it's worth. If you're buying it under market value, your uncle's giving you a house for 50 cents on the dollar. A conventional lender just doesn't care. They're going to base it off what you're paying for it or what the appraised value is or whatever's less. Also builders, if builders are looking for new construction money, we can do that. A little bit different criteria. We do typically require about 10% down on those. And then also investors needing cash out. A lot of investors have properties that have been paid off and maybe they need to leverage that to buy another property or take their family on vacation, whatever it is they want to do. So you can go to a hard money lender and pull some cash out. So we get this question a lot about credit on the hard money side. Does credit matter? And I always tell everybody, most questions in real estate are answered with it depends. And all it depends on your exit strategy. So what are you going to be doing with the property? If you're flipping the property, so I'm going to get paid off, the lender's going to be paid off when you sell that property. So credit doesn't matter as much. We are going to look at credit. We like to see who we're lending to. Credit does, say a lot about someone's character and so forth. But that's not going to pay us off. But if you come to us and you tell us, well, I'm going to refinance this into a long-term loan, so that tells me something different. That tells me that we are relying on another lender to refinance us. And so since we know both sides of the game here, we're going to make sure that you qualify for that loan. So, if you're going through conventional standards, we got to look at your credit score and make sure it's above 650 typically. If you're going to a typical bank, somewhere on the same thing. If you have a private lender, it might be different, but we always have an exit strategy. We also want to see if you have any liens or judgments, IRS tax judgments, anything like that that could hinder the property or attach itself to the property. So we are going to pull your credit. Determining ARV, we always get questions about this. Probably one of the biggest things that a new investor needs to do is how to figure out the ARV of the property and also figure out what it costs to do the repairs. If you are new, those are the two things that you need to focus on the most, in my opinion. Because if you can figure out the ARV and you can figure out what it costs to fix it, now you know how much to offer that seller. So those are the two pieces of the puzzle that you need to focus on. So ARV is easy. I mean, you can call us and give us an address and we can tell you an ARV pretty quick. Figuring out the repairs might be a little bit different. That takes a little bit of time. We'll talk about that a little bit later. So ARV, if you actually go through a loan process with the hard money lender, we're going to get a licensed appraiser to go out there. So this is nothing that we control. We do have approved appraisers, only appraisers that we work with, but you are more than welcome. And we encourage you to meet the appraiser out there to provide any sales that you think are relevant. Have your contractor meet the appraiser out there, because the more information you give this appraiser, the better. They need to know what this house is going to look like, what the finishes are going to be, if there's any walls being moved, anything like that. So if you can be there, and especially if your contractor can be there, that would be greatly, greatly helpful, because we're looking at, again, the after repair value, what that property is going to be worth after the project is completed. Typical hard money terms, and I'm talking generalities here, not really what Noble Mortgage offers. We're somewhere probably right now in the range here of what I'm giving you, but I'm giving you a range of what's out there in the market. Again, 6 to 12 months, you can see rates of 9 to 13%. We see origination fees, which is a percentage of the loan amount of 2 to 4% of the loan amount. Plus you have your other customary closing costs like title and appraisal and so forth. So, these are not cheap loans. These are more expensive loans. So you have to add these costs into your profit figures to make sure that that deal is still going to make sense for you, because it is a more expensive loan. Noble Mortgage also offers term loans. If you see that third bullet point there, and that means we will go longer than a 6 to 12 month loan. We will do a 20-year amortized loan that's principal and interest that will have a balloon payment on it after, say, 5 years. So that's something a little bit different that we do. We've always offered those types of loans, whereas most hard money lenders only do short-term loans. We'll actually do long-term loans. I actually have a loan on a daycare center that I've had for 15 years, believe it or not. So, it's one of those situations where, people have less than perfect credit. They can't get conventional financing. And, we always tell them, look, get your credit cleaned up. We'll help you arrange that loan. But some people just don't do that, unfortunately. So that's my longest standing loan right now, is my 15-year daycare loan in Baytown. Qualifying for a hard money loan. Again, we always look at exit strategy. What is it you're going to be doing with the property? Are you keeping it? You flipping it? Whatever it is. Property and location, of course. 3 rules of real estate are location, location, location. Again, we're going to pull credit depending on what your exit strategy may or may not have an effect on our approval. Cash reserves, always like to see you have a little bit of money in the bank, just to make sure that, if there's a cost overrun on the budget, or it takes you longer to sell it, what have you, there's always things that come up. Real estate is very capital intensive, so it's always good to have some money in the bank. How much really depends on size of the loan amount, as well as the size of the budget. So the bigger the budget, probably the more money we want you to see in the bank, because typically you're having to fund your contractor up front, and we'll go over that here in a minute, to get them started. So you got to have a little bit of money in the bank, even if I give you 100% financing. Items you need to qualify. Again, what are you doing with the property? Our simple application that we have is 1 page, and we pull a credit report, and we like to see a bank statement, see what kind of cash reserves that you have in the bank, whether your name personally or your business. If you're looking for long-term financing, then of course we are going to want a lot more information, because we'll make sure that you qualify. Let's see. I'm checking to see if we have any questions in here. Someone said they were getting glitchy audio. I think it's just on that person's end. Okay, someone's asking about commercial property. I'm gonna have to get to that later. And someone just asked, they have to leave at 1:30. Is it being recorded? Yes, it is being recorded. I'll have, that's from JC Hickman, Courtney. I'll have Courtney reach out to you about that, how to view that. And then, do you need a tax return? Someone just asked. Again, it depends what you're doing with the property. Someone just asked if you need a tax return. If you want to qualify for long-term financing, yes, I do need to see tax returns, because I'm going to treat that loan as like it were a conventional loan. And so a conventional lender is going to want to see 2 years tax return. So if you're going to flip it, no, I don't need your tax returns. And yes, we do pull 3 bureaus, Roxy, to answer your question. We pull a 3 bureau credit report. So this is really all we need to get started: application, credit, and a current bank statement. Once you have a property under contract, then we do want to see an itemized repair budget, specs and plans if you have any, as well as an executed contract on how we get access to the property. So working withdrawals. Working withdrawals is a fairly simple process, although you do have to talk with a different, each lender has a different process. Some lenders may only allow you to take a draw, twice a month, once a week. I don't know. It just depends. Everybody's different. We're not as regimented. We're really flexible on this process. And we also like to get the money out it's one of our 5-point guarantees, is that we get the money out to you within 3 days, provided we have everything from you and we get access to the property right away. You always want to ask about draw fees. What does it cost? every time that you do a draw, because that's part of your expense. So our draw fees are $150, which is very reasonable. It's just a pass-through fee to our inspector that goes out there. But some lenders might charge substantially more. I've heard some lenders charging $200, $300, $400 every time there's a draw. So make sure you understand those fees and how they work and how often you can do them, and have that conversation with your contractor. Other things, make sure that the work is 100% complete. If you're asking for a draw on a roof, for example, and the inspector goes out there and it's halfway done, well, we're not going to issue the draw. That work has to be 100% done. It needs to be completed. You also need to make sure that you have the proper inspections have been done with the city. You've got your permits and so forth. That's becoming a big deal. The city is getting more and more, they're starting to look out for that stuff a lot more, especially I had a conversation with a friend of mine yesterday who was in San Antonio, but they've put together some kind of new force in San Antonio to make sure that permits are being done. If you don't have a permit, they will shut you down and make your life very, very difficult. Will, I'll put my office contact in Dallas there in a minute, but it's Johnny Hines. I can give you his number. So this is what we want your budget to look like when I say itemized repair budget. So as you can see here, everything is itemized, roof, foundation, windows, and so forth. Because when we issue your draws, this is exactly what we go off of. We go exactly by what your budget says. So roof, $4,500. If you come to us and say, well, the roof was actually $5,000, that's a cost overlay that you're going to have to handle unless there was a contingency in the budget. So make sure that your contractor gives this to you. It also helps you get an idea. What I always tell people, if you have trouble estimating what things are worth, looking at a lot of repair budgets is very, very helpful in walking property, because eventually you're going to get an idea of what it costs to fix things. And so you review these and walk a lot of houses, eventually you'll know. Oh, thank you for doing that, Courtney. Can the property be outside the Houston area? Absolutely. Hard money loans will lend in all the major metropolitans in Texas, Houston, Dallas, San Antonio, and Austin. So repairing the home, again, the more information you give us, the better. If this is a flip property, we want to make sure that you're going to make this house the prettiest house in the neighborhood. Okay, it needs to have all the same bells and whistles that all the comparables have and so forth. That's going to affect your value. If it's a rental property, you won't really care as much. It needs to be clean, needs to be functioning, needs to be comparable to the other homes, but not necessarily the highest sale in that neighborhood. So when you are looking at ARV and you're holding it as a rental, you don't want to look at other houses that have been fixed up to the nines if you don't plan on doing that. So you have to be careful about how you do your comps. So make sure you pay attention to the pictures and what finishes there are. If you're flipping, of course, you could probably get the highest value if you do everything right. But on the rental, probably not. We talked about the itemized bids, setting expectations with your contractor. Make sure that you walk the property with them and an idea exactly what you expect as far as timing. Make sure they can stick to their budget. Always vet your contractor as well, and always do a final walkthrough. So another question we have is outside of Houston, smaller cities, Jerry, such as Luling, case-by-case basis, really. I typically stay away from smaller towns. I'm a little more likely to fund a hard money loan in a small town if it's going to be held as a rental property. If it's just a flip, it's probably going to be a no, unless it's, really close to Houston, Dallas, Austin, or San Antonio. We just don't have inspectors there. It's hard to get appraisals. It makes it very, very difficult when you're in those smaller towns. So typically we stay away from those. Will's asking, if your initial budget is $5,000 for a countertop, but the completed work is only $4,500, do you still pay the $5,000? You're not paying the $5,000. That's what's being held available for you, Will. So if you only draw $4,500, then we would issue a check for $4,500. That way you're not paying interest on the $5,000. If you have money left over after the home is complete and you want to draw that down to help pay for interest or anything else, you're welcome to do that. If you don't want to draw that money 100% down, you don't have to. We have lots of loans that have paid off where they haven't drawn down the full amount of the repair budget just because they just didn't need the money or they didn't want to pay the interest on it. So that's up to you. Potential pitfalls with hard money. First two are always the biggest things the biggest hurdles you have to be aware of: overestimating your after repair value and underestimating your repairs. if you can get those down, that'll be greatly helpful to you. Undercapitalizing, of course, that's why we look at cash reserves, making sure you get the property done very, very quickly and correctly. A lot of people, it seems like it just takes them a little bit longer to get everything done. And then they have several other projects going on and they move on. They let that property sit while they're paying high interest with the hard money lenders. Never a good idea. And then, of course, pooling permits. Again, this is becoming a bigger deal. Hard money lenders in general are starting to pay a lot more attention to the permitting process because the cities are making it very painful. It's not very difficult to pull permits, but when you don't pull them, it can be very, very difficult. So questions you should be asking lenders if you're shopping for a hard money loan. This should give you an idea. Again, I've been doing this a long time. I know all the little tricks of the trade and all the bells and whistles. And some lenders like to overpromise things up front and promise you these low fees and low rates, and then when you actually peel the layers of the onion back, you realize there's these other things in place. So you got to make sure and vet everybody out very, very carefully. Hard money is not highly regulated like conventional lenders are, so you have to be able to vet them out, look at their reviews, ask for references, and ask for a detailed breakdown of any and all fees that they have. So some of the things I would ask: inspection fees. What do they charge for inspection fees? How often can you take those fees? Things like that. So those things with withdrawals are very important. How many can you take? Is it a certain day of the week, certain day of the month? How does that process work? Are there any additional holdbacks? For example, on our budget, we're talking about the Will was asking about the countertops for $5,000. Some lenders will only give you 90% of that. They'll say, well, your line item is $5,000, but we only fund 90% of that, so we're going to hold back $500 until the end of the project. So you need to ask that because that's going to affect your cash flow along the way. How long the draws take. We've ran into several customers that have tried other lenders and it just took 2-3 weeks for them to get a draw. Very, very difficult to keep your projects going if it takes that long. That's why we implemented those into our 5-point guarantee to make sure that our customers get their draws in a minimum of 3 days. Are there any prepayment penalties? Prepayment penalties, if you finance the property and then you pay it off right away, is there any penalty that goes along with that? Are there any minimum interest earned? Some lenders require you to pay at least a minimum of 3 months worth of interest. So if you pay the loan off in a week, let's say you happen to get it sold, you may have additional fees. So make sure you ask those questions. We don't have any additional interest earned. We charge fees at closing like most lenders do. If you pay us off, you pay us off. So no additional fees. And then of course reviews, we talked about that. David's asking, can the hard money conventional loan option be used for a personal home? Or is it? No, this is for investment properties only, David. Most hard money lenders do not do anything on the consumer side, which means you're going to be living or residing in the home. That's an entirely different type of loan, entirely different type of disclosures required, and so forth. So next, we're going to talk about holding properties for rental. Using a hard money loan to start and then refinancing that into a long-term loan. We have a loan program called Joe the Investor Loan. So this is a rehab to perm loan that allows you to start off with a hard money loan. It's a 2-loan process, okay? And then once the repairs are completed, you refinance it into a long-term conventional loan. So what this allows you to do is leverage yourself. Again, if you go buy a property right now using a conventional loan or going through a regular bank, they're going to require you to put down 20% of whatever the purchase price is, okay? If you have limited cash, that's going to be difficult for you to build a big rental portfolio. So going with a hard money loan, if you can get 100% financing, it might be a more viable option because you can build a rental portfolio of 10, 20 houses with very little money out of pocket. So that's what a lot of investors do. We do these loans all the time. They come to us for the loan. They do the hard money. Once the repairs are done, we refinance it into a long-term loan. It's a great way to build a rental portfolio. Again, why the 2-loan process? It allows you to get 100% financing. We will actually bump our loan to value up to 75% instead of 70%, which is what we normally do on flips if you qualify for long-term financing. So we talked about hard money and how to use that for a flip, how to use that to build a rental portfolio. So if you are going to keep the property as a rental or you're looking for long-term money, we're going to talk about the different types of programs that are available for those types of loans. So starting off, we always go to just the standard conventional loans, and what those are, I'll tell you in a minute. So let me tell you what's changed on the conventional side. So not unlike every other lender since COVID-19 hit. The conventional lenders have gotten more conservative. Initially, there was a huge difference in what was happening before. The lenders were putting into place what are called overlays. And so Fannie Mae and Freddie Mac have lending guidelines that they go by that allow these lenders to sell these loans to. However, some of the lenders themselves install what's called overlays. And so maybe Fannie Mae allows a 680 credit score, and then this lender says, well, we're actually going to make you have a 700 credit score because that's our overlay. So there was a lot initially. There's not as much anymore. A lot of those have gone away. One of the big ones that has remained is you used to be able to get an 85% loan on investment property, and that was lowered to 80%, and it has stayed that way. And then secondly, self-employed people are getting a little more scrutiny because of what's going on. A lot of businesses is closed, so the conventional lenders are being a lot more conservative. So one of the things that they're requiring is if you are self-employed, you are required to submit a year-to-date profit and loss statement. So they want to see that you're still viable, that this shutdown, COVID-19 has not affected you. I can tell you from my standpoint, I refinanced my personal residence in, was it May? I think it was May. And boy, I own a mortgage company, so I don't have any pull with these lenders either. So don't think it's just we're picking on you if you're self-employed. But I did this loan and I had to give them all kinds of stuff, year-to-date stuff, a letter from my accountant, all sorts of things. And then literally the day before closing, they wanted me to prove that I was still in business. So I said, well, how am I supposed to do that? You want to come to my office and look? What is it? So they said, well, okay, if you can give us a settlement statement on a transaction that has closed recently showing that you're still in business. So we did that. We took a closing settlement statement. We blacked out the names and addresses, and so you could not identify who it was and so forth. But we sent them a copy of the closing statement so they could see that we were still in business. So they're very skeptical, very conservative. They're looking very closely at self-employed people right now. And even if you are employed, if you're gainfully employed by a regular W-2 job, they're calling and verifying that you're working there up until the day of closing, before they would do it sometime during the loan. But it seems like now we get called all the time, right up to the day of closing to make sure that they're still employed. So, lenders are trying to be careful what's going on. And then we talked about this when I first started. Everything's taking a little bit longer turn times. Okay, we have another question here from Greg. For the Rehab to Perm loan, will you lend to LLCs? And if so, what are you looking for in terms of proving income? Good question, Greg. We will lend to an LLC, but you're limiting your exit strategy. And it's like you led me into my next slide. So for a conventional loan, if you look on the right side there, one of the disadvantages, Greg, is that a conventional lender will not lend to an LLC. It has to be in an individual's name. However, there are programs available for you if it is an LLC. It's just not a conventional loan. And that's our next loan program. I'll go over those for in a minute. So conventional loans, these are 30-year fixed mortgages. If you're going to build a rental portfolio, in my opinion, and it's just a simple matter of cost, this is the way to go. These are very, very, very low interest rate loans. They have fixed rates set for 30 years. There's no prepayment penalty. This is as good as it gets. Right now on investment property, the rates are about 4%. So you can get 4% on a 30-year fixed mortgage for a rental property. That's stellar. I mean, we've never seen that. As long as I've been in business, as long as I've been in this industry, I've never seen 4% on a rental property. So very, very aggressive terms. So, and they're very simple. They don't, you don't have to report your tax returns to them like a bank might require and so forth. Once you get that loan in place, as long as you pay your note, they're not going to mess with you and pay your insurance and so forth. The disadvantage of a conventional lender, if you start off with this loan as opposed to going through a hard money first, is that they're not very high leverage. They're going to make you put down 20%. They do have strict lending guidelines as far as credit, debt to income ratios, and so forth. They don't allow any fixer-uppers. They're not going to give you draws. If the property is not in good condition, they're not going to even lend on it. So the property has to be in at least livable condition. It doesn't have to be the cleanest, doesn't have to be the prettiest, but it has to be very functional. No holes in the wall, no broken windows, can't need a roof, anything like that. All that has to be done prior to them financing it. Conventional lenders also only lend to investors that have less than 10 residential properties that have financing on them. So if you own 11 houses and they all have money on them from somewhere, whether it's from your parents or a private lender, whoever, they don't care. They will no longer lend you conventional money. They like to cap it out to 10 loans to limit their risk. And then lastly, no LLCs. You cannot go to a conventional lender with the property in the name of an LLC. Someone's just asking if there's a bank statement program. There is. That's actually my next lending. It's almost like you guys are setting for every slide. I love it. You guys keep them coming. That is our next loan program. I'll tell you about that and how that works. We call that it's actually not my next one, 2 ones after that. How do you qualify for a conventional loan? We have an application. They do have certain credit score requirements. We're going to go over those here in a minute. 2 years tax returns, current bank statements. So you have to give the full gamut as if you're buying a house to live in for the first time. So when it comes to credit scores, and this has been a moving target for the last couple of years, but right now this is where it stands. So your first 6 properties, you need at least a 640 credit score. Okay. Once you go to your 7th property, they bump the credit score requirement up to 720. Okay. So 640 for your first 6, 720 for 7 through 10. After that, again, you're done. You have to move on to other loan programs. David's asking, conventional lenders are still having you wait 6 months if you bought and repaired with your own cash. No, David, you can refinance. If you pay cash for a property, you can refinance it immediately. You do not have to wait. However, they're only going to give you money back for what you paid for the property. So if you paid $80,000 for the property and it appraises for $200,000, whatever it appraises for, they're only going to give you that up to that $80,000 that you paid for it, and they will not include any repairs that you did or anything like that. If you're wanting to pull out money above and beyond what you paid for it, then yes, you do have to wait 6 months. So it depends what is it you're trying to achieve there, David. Good question, though. Cash reserve requirements. Again, this has always been a moving target. Right now, it depends on how many homes you own, and they make you have in reserve a percentage of the principal balance of those houses. So if you have up to 4 houses, it's 2% of the principal balance on each property that you own. So they need to know how much you owe on each one, which is typically on your credit report. You get up to 6, it becomes 4%. You get beyond 6, it becomes 6% of the principal balance. So they're trying to make sure that you have enough cash reserves in case there is a downfall in the economy and you lose several tenants and so forth. Plus, you also need to have 6 months worth of principal, interest, taxes, and insurance on the property that you're buying. Brian's asking, just to confirm, the portfolio loan will need to be under your name personally, not your LLC. Not the portfolio loan, Brian, the conventional loan. Portfolio loan is what we're covering next, and they do allow an LLC. And there we are, portfolio loans. So portfolio loans are really, for people that want to leave it in the name of an LLC, or they've already got 10 properties and they need other alternatives. And so these are really just banks, small community banks that we work with that do like the residential lending side. Not all banks like that sort of thing. So what's changed since COVID with these lenders? Again, it's kind of like the hard money side. They're definitely more conservative. Each bank is different. They have their own set of criteria, but they're definitely more conservative. It's a case-by-case basis. We haven't seen anything common other than it's probably the same thing the hard money lenders do if they want you to have a little more cash reserves. So again, these are just community banks. Some of them are credit unions that we work with, but not all banks, like residential lending. So these are not the big banks, Bank of America, Wells Fargo. These are small banks that we have a relationship with. And even some of the small ones don't even like residential lending. Each bank is different. Some banks love to lend on hotels, for example. And some banks like residential. So you just got to know which banks to go through, who those contacts are, which is what we do. We help you connect with those lenders. Portfolio loans, also very, very good loans. These are reasonable costs. Interest rates are in the 5s typically. They don't limit you on the number of properties you can own. You can leave it in the name of an LLC. You can even do what's called a blanket loan. And that's when you have a loan on more than one house. So let's say you're buying 5 houses all at the same time and you want to limit some of your closing costs by getting one loan and simplify the accounting. Well, you can do that. It's called a blanket loan. No other lender will do that as far as conventional and so forth. No prepayment penalties like the conventional lenders, which is good. So you're not going to, if you can pay it off early, it's no big deal. Again, like conventional, these are lower leverage. They typically require 20% down if you're using that loan to start off with. Excuse me. Another disadvantage, probably the biggest disadvantage, other than the rate being a little bit higher, is these are shorter term loans. So not only is your amortization shorter, but there's typically a balloon on these loans. And so what we tend to see is 20 to 25 year amortizations, okay? Whereas on a conventional loan, you can get a 20 to 25 year amortization. So that's going to make your payment a little bit bigger because it's a shorter amortization. But then on top of that, there's going to be a 5-year balloon. So a balloon, which means that within 5 years, you have to either pay that loan off, refinance it, or work out an extension with your existing lender, which that's not difficult to do. However, where are the interest rates going to be in 5 years? Nobody knows. Are they going to be the same, higher, lower? Your guess is as good as mine. So it does subject you to interest rate risk. So that's one of the downfalls of the portfolio loan. And then lastly, if you have several loans with that particular bank, they may require you to submit your tax returns every year. So there is a little more touchy-feely. They need to see exactly what's going on in your world financially. How do you qualify? You know, again, each lender is different, but they're typically going to have at least, 650, 660 credit score requirement. They're going to look at 2 years tax returns. They want you to have cash reserves, experience if you're buying several houses or you're doing a big job and so forth. And then they also want you to have a depository relationship. Of course, that's what banks are here for, right? They want you to have a bank account. So, if you have several loans with that bank, they may start hitting you up for more deposits and so forth. So it really just depends on the bank. Typical terms we're seeing right now, rates are still low, in the 5s right now. You can expect to pay, 1.5% to 2% in origination fees. Again, we talked about the amortizations being a little bit shorter. So if you're building a rental portfolio using a portfolio loan, then, you're going to pinch your cash flow a little bit by having shorter amortization. So keep that in mind. Types of loans and properties considered, again, case by case. Typically, we're talking about residential here, but some of them will do some mixed use properties as well. Okay, now that we have talked about portfolio, we're going to talk about non-QM loans, and QM stands for qualified mortgage. Just so you know, in 2008 or 9, whenever Dodd-Frank came through, they came up with this term called qualified mortgage, which was built for conventional lenders that are doing long-term loans for home buyers. People are going to be living in the house. So they wanted to create a standard that required the lenders to document income in a certain way to make sure these people could actually afford these houses. So all those rules are really attached to consumer loans, or when people are going to be living in the house. So what came about is it's really just a subprime loan like we used to have back before the Great Recession, but subprime became a nasty word in the mortgage industry. So now they changed it to non-QM loans, and they're really, again, just subprime loans. So someone was asking about bank statement loans. Yes, there are bank statement loans for owner-occupied and non-owner occupied. There's even loan programs where they don't require any tax returns, any bank statements. They strictly go by market rent in the area or what your property is currently leased for. It's called a debt to income loan. So these are pretty good loans. They were getting really, really aggressive right before COVID-19 shut everything down. And so kind of like some of the hard money lenders, when COVID-19 shut down our country, every single one of these lenders pulled the plug. Completely pulled the plug. We couldn't even get them to answer our phone calls. So they just vanished from the market. And they were, at the time, I mean, literally weeks before, these lenders were popping up left and right and getting more and more aggressive, fighting each other for business. And then, man, that shutdown came and they vanished. I mean, they were gone. So they have come back around. They're not quite as aggressive as they used to be, but I was pleasantly surprised to see that they came back around. I was getting worried there for a little while. And these are typically operated by big money hedge funds and so forth. So they've got some interesting loan products out there. One of the biggest changes that's happened since COVID-19 is they're requiring a 6-month seasoning, whereas before it was 3 months. So if you are transitioning out of a hard money loan and you want to go by the value, not what you paid for it, you do have to wait 6 months right now, whereas before you only had to wait 3 months. They've also lowered their loan to values from as high as 80% to now around 60 to 65%. We are in discussions with one lender that's claiming that they can do an 80% loan, but I'm still vetting them out. I want to make sure they can perform before I start submitting loans to them. So I'll keep you posted about that if that loan comes back around. The rates have stayed the same. I was a little bit disappointed that the rates didn't drop. You know, conventional rates dropped quite a bit after COVID-19 because the market just, you know, crashed, and so the rates weren't super low. But these non-QM lenders, they didn't change their rate at all. They're typically right around 7%, sometimes a little bit higher depending on the deal. So your advantages of non-income loans or non-QM loans, again, no tax returns. These are longer term loans. These are 30-year loans. Some are fixed for 30 years. A lot of them can become adjustable at some point. Again, the rates are okay. They're 7% range. You can expect to pay a couple points on these deals. You know, the leverage has dropped quite a bit. Again, we're down to 60, 65% as opposed to 80. I'll let you know if that changes. Each lender will typically only offer 10 loans for each customer, but there's plenty of these lenders out there, so we have never run into that problem. Some of the rates are adjustable, although some of them are fixed right now, so adjustable is not really a disadvantage anymore. And one of the big things is they have prepayment penalties. And so if you pay this loan off anytime before in the first 3 years, these lenders are requiring you to pay 6 months worth of interest on that loan. So that's a hefty penalty. So you need to keep making sure that you can stick out 3 years in this loan before paying it off, so you don't have to eat that 6 months worth of interest. Someone was asking about construction loans in the chat. I'll go ahead and answer that now since we have in our questions and so forth. Yes, we do construction loans on a hard money basis, typically about 70% of the after repaired value, but we do require 10% down in order to do a construction loan. You do have to have experience and so forth. Andres is asking, is it possible to get a copy of this presentation? It is. We would love to give you a copy of this presentation. Courtney can send those to you. Typically, we require that you fill out a survey for us, let us know what you liked, didn't like about the presentation, or if there's anything you'd like to see in the future. I'm not sure if we're still doing that or not. I'll let Courtney chime in on that. But yes, we can give you a copy of this. Typically, we'll send it to you in a PDF format. And if you guys have questions for me after the presentation about anything related to financing or loans, even if I'm not your lender, you're working with somebody else, I'm a big believer in abundance mentality. So ask away. You can email me at ask Darel, sorry. Ask Darel at noblemortgage.com. Any questions about financing? Gosh, I did that wrong again. Sorry, guys. Courtney, if you can delete those, that would be great. With the wrong email address. So it's askdarel at noblemortgage.com before I put enter. That's my email address. So
I can't remove them, but we can just make sure you guys go off that last one, the Ask Darel. Sorry about that, guys.
Okay. Anyway, there's my email address. You can call my office as well, 713-680-8100. Any more questions on what we covered today? Again, if you're a realtor, contact Courtney. You can send an email to her at events@noblemortgage.com. There we go. noblemortgage.com/events. That's our website, is noblemortgage.com. If you go there, you can register for any upcoming events. Again, if you're a realtor, you need CE credits, send that email to events@noblemortgage.com. So we've been doing these all online, obviously, since we can't do our regular happy hours and so forth. So if you enjoyed this, please go to our website and sign up for all our future ones. We've been doing a happy hour. We have a midday networking event we do. Then, of course, we're doing the webinars. So those have been fun. All these are being done on Zoom. It's a little bit different. Not quite as fun as hanging out in a bar, having a drink with some of my real estate peeps, but we got to keep networking. If you are interested in downloading our app, we have a hard money calculator, which is available on Apple and Android. It's referred to as the hard money calculator. And this is a real cool little calculator. It's real simple. Just allows you to calculate, you know, what your closing costs would be, profits and things like that. It's nothing too high tech, but it is a nice little calculator to have on the go if you're out in the field looking at a deal and you need to run numbers real quick. My loan officers even use it. I figured out, I saw them using it several months ago when we first came out with it. So it's a great way just to kind of crunch some numbers real quick. Any more questions on anything I covered before I turn it over to Jason? Jason, you still with us?
I am here.
You didn't fall asleep on my presentation?
No, you know what? I do want to say this. Like, there's a couple of guys that lend money in this town. And I'll tell you what, nobody puts together a presentation like you do. That is, if you're brand new to this business, that was a very good, comprehensive introduction to how all these different loan products can work depending on where you're at in your real estate investing cycle. I've run into people before that have been doing this 20 years and they don't know what a non-QM loan is. I'm like, man, that's like magic if you're at a certain level or a certain place. So I think that was a fantastic presentation.
Thank you, my friend. I appreciate that. Yeah, I like to know what I'm doing. So hopefully, after doing this for over 20 years, I have an idea, but I know what you mean. Anyway, do you want to share your screen? Guys, this is Jason Bible. Jason's been in the industry for a while. Let him tell you a little bit more about himself. But we've done events together. We've done all kinds of things together. We've drank probably too many beers together at one point. But Jason's going to talk about how to invest in a COVID-19 world. And if you guys, again, have questions, use that chat box. And I will turn over to you, JB.
All right. Well, thank you so much. And a big thank you to the Noble team for letting me come out and present today. It's always fun to present. And like Darel said, it's a little weird not having the in-person networking events, and can't wait to get back to that as soon as possible. So I want to start real briefly and just give you a little bit of my background and then share kind of what's going on in the coronavirus new world here. I started in July of 2013. I started a house flipping company. In that first year, we bought 7 houses. In 2014, we bought 67. And then 2015, we did 90 plus. So fast forward to 2018, we were doing about 100 houses a year. And you can make some decent money flipping houses, don't get me wrong. But, real wealth is created in holding assets and holding onto property long term. So in 2018, I sold that house flipping company and a real estate education company to my former business partner. And since October 2018, so about 2 years now, I've been focused mainly on buy and hold real estate. And that's typically single family, long-term rentals, short-term rentals, Airbnb, and small apartments. And I'm up to about 300 doors now with my business partner, Robert Orfino. We own a construction company. We own a handful of other little companies that help us rehab these properties. My portfolio, 60% of it's in Houston, and another 40% is down in Corpus Christi. So fast forward to February this year. In fact, I can pull it up on Twitter. I tweeted out on February 2nd, investors, you really need to watch this coronavirus thing because more than likely we're going to enter shutdowns and lockdowns, and the United States is really going to overreact to this thing. And at the time, we didn't consider it an overreaction, but there's going to be a huge impact to this. That was back in February 2nd. Fast forward till about March 13th, March 15th, and the whole country is shut down. So one of the things that we pride ourselves on here on the Mr. Texas Real Estate team is data. We're always looking at data. We're watching the news. We're looking at the underlying economic conditions to really get an idea of what's going on in a marketplace. So most of the property that you as landlords and long-term buy and hold investors are going to buy in the city of Houston is going to be houses priced $150,000 and below. And why is that? Well, it's quite simple. They cash flow the best. Now, $150,000 and below is the sweet spot for landlords. It's a great market for Airbnb. It's just that's a good market to be in. When houses become much more expensive than that, from a long-term buy and hold standpoint, they typically don't cash flow. So your negative cash flow, the insurance is more expensive, obviously taxes are more expensive, but the rents don't follow with the increase in price. When you get over about $1,500, $1,600 a month rents, there's just not a whole lot of renters out there looking for those properties. So one of the things that we track, and this is we're going to go into a little bit of what's happened at the start of the coronavirus stuff and kind of where we're at now. When we went into the coronavirus, if you guys remember, real estate essentially shut down for about 3 weeks. In fact, let me see if I can pull the data up. If you guys are familiar with showing time, Showing time is a service that shows how many times properties are, how many times properties are shown in a given time period. So in other words, these are not necessarily open houses, but if a real estate agent wants to take their client to go look at a house, they'll schedule a time to show the house. So showing time tracks all that data. You can see here about March 13th, March 16th, that's when the entire country was shut down, and bang, it dropped 48%. There was a 50% reduction. This is a 7-day moving average. There was a 50% reduction in showings. Well, what happened? Well, if they're not showing houses, you're probably not buying houses. So for this 4 to 6 weeks here, everybody was kind of freaked out. Bond market was freaking out. Darel mentioned the non-QM lenders. We work with a couple of them. And I will never forget, I'm going to meet these guys in person one day. We had 21 refis with these folks. And right around here, just like Darel said, they literally stopped answering the phone. Like no one answered the phone, nobody answered the email. And I kid you not, about 8 weeks ago, they sent out an email to all their clients and said, "We were with you from day one and we're with you now. Send us your stuff, let's close some loans." And I'm like, I couldn't even get you guys to answer the phone back in March. So anyway, the non-QM guys are back. We can talk about non-QM loans here in a little bit. It's one of our favorite ways to finance properties these days because they work so well for us as real estate investors. So let's go back here. Everyone's freaking out here, and for good reason. 90% of GDP, which is the measure of an economic output of a country, 90% of GDP was sitting at home watching the Tiger Show on Netflix. Nobody was working. No, I shouldn't say nobody's working. Everyone's running to the grocery store buying toilet paper. You guys remember that? That seems like it's a million years ago, but I swear it was like yesterday.
Yeah.
Yeah, it was wild, right?
I still haven't figured that one out.
I still haven't either. I'm like, why are all these people buying toilet? And I was like, am I missing out on something? What's going on here?
Yeah.
So everyone's freaking out. And then fast forward a couple of weeks and we're like, okay, we're getting in this new normal. We can't go to restaurants, can't go to bars, can't do anything fun. But everyone's kind of figured out how to work from home and that sort of thing. So the assumption was, well, real estate is going to crash. And I said from the very beginning of this thing, one of the things that people fail to recognize is the single family home is now the most important asset in real estate. It used to be Class A commercial. That's not true. We have a bunch of investors that we work with that have Class A triple net leases. This is like CVS, Walgreens, Apple, Nike, like big companies that stop paying their rent. And think about that for a second. Their private money loans on a single family house were still continuing to be paid, but their Class A corporates stopped paying and basically said, sue us, we're not paying. We're not paying our rents. So it was a really wild time. But what it did is it accelerated an already rapid real estate market. And I don't think it's going to change anytime soon, but I'm going to share with you some of that data here in a minute. This is Matrix. It's the back end of HAR, Houston Area Realtors. If you are familiar, if you're a real estate agent, you play in this all day, right? This is your Bible, if you will. I'm looking at houses. Let me show you the map. In Houston's pretty big. Houston is 100 square mile or 100 miles by 100 miles. It's 10,000 square miles. Houston is the largest real estate market in the country, period. Nothing comes close to the size of this market. Absolutely nothing. In fact, this market's so big, it's bigger than some states. You guys are familiar with fortune builders. Those guys started in Connecticut. Houston is larger than the entire state of Connecticut. It's the largest market in the country. Nothing comes close to it, especially for single family. So this is the market that we are principally associated with. Galveston up to the Woodlands, outside of Katy, not quite to Fulshire. This is Baytown, Pasadena here. And I actually have a handful of assets in Surfside, and I'm starting to buy stuff in Lake Jackson. But this is really the Houston market right here. So when I do a search in HAR, houses below $150,000, there's only 367 on the market. Now, I used to work for this guy named Bob. Bob Emery is amazing. I owe a lot to how I analyze data, to how that guy thinks. I worked for him for almost 15 years. And one of the things Bob is famous for saying is, as compared to what? So 367 houses sounds like a lot of houses. But for the fact there's like 30,000 properties listed on HAR. It's like 0.1% of the marketplace. So when people say like, oh yeah, there's plenty of deals out there, you know, we're going to be able to invest in Houston forever. I'm like, that's not true. This marketplace here, below $150,000, is shrinking rapidly. And let me share with you some of those numbers from the past month's HAR report. I'll get into some of these at some point, but this down here is very interesting. Houses below $150,000 have decreased 23% in total sales. Well, what does that mean? There's just fewer of them. There's not as many $150,000 and below houses out there. So right now, there are 367 houses for sale $150,000 and below. Sounds like a lot. I mean, you could pick 370. So the next question is, how fast do they sell? So let's do this. We're going to look at option pending, pending continue to show, and pending. Let's see how many sell, or how many got under contract and to sell in 7 days or less. 197. You guys can see the numbers right here. So that means if you put a house $150,000 or below on the market, 52% chance it will sell in 7 days. 52% chance it sells in 7 days. That means if the house is below $150,000, there's a 52% chance it will sell in 7 days or less. Now, for those of you who are realtors, you're familiar with this term right here called single family months of inventory. So that means if no other houses were to be listed in the market, this is the number of months it would take to completely sell out the marketplace. And you'll see we're down to 2.5 months of inventory, which is insanely low. Let me explain to you why this metric is important. Months of inventory explains where we're at in a marketplace. Who has the advantage? Is it a buyer's market or a seller's market? When you get below 6 months of inventory, the seller is the one that's considered to have the advantage over the buyer. That's called a seller's market. When you get above 6 months of inventory, the buyer has the advantage over the seller. Now, if you guys are not familiar with an economist here in Texas, you probably should be. His name is Dr. Dotsauer. And one of the things Dr. Dotsauer has said is he says, look, I've got 40 years worth of single family, specifically Texas real estate data. And what that data tells me is that when months of inventory reach at least 10, in other words, you have 10 months of inventory, you can expect a decline in prices. Not a real estate crash, just a decline in prices. So here's what's interesting. The broader market in Houston has 2.5 months of inventory. If you're to look back here at Matrix, we're at 197 sell in 7 days or less. That means if your house is below $150,000, there is less than 1 month's worth of inventory. I'll say that again. For houses priced below $150,000, there's less than 1 month's worth of inventory. So if there is a real estate crash, you would have to tenfold increase the months of inventory before we'd even see price reductions below $150,000. That's absolutely insane. And let me put it this way. I've said this on a webinar before. That's not an economic crisis or a 2008 real estate crash. For us to experience that level of price decline or inventory expansion, like Russia and China and Iran would all have to be shooting nuclear missiles at the United States. I mean, it would have to be cataclysmically bad. Now, is it statistically possible? Yes. Is it probable? No. So when you hear people talk about a quote, real estate crash in Texas in the next 5 years, I would take that with an enormous grain of salt. This market was absolutely on fire before Corona. It has gotten even more hot. In fact, I'll show you two numbers right here. Total property sales are up 32%. Total active listings are down 25%. Let me say this a different way. Demand is up 32%. Supply is down 25%. That 56% delta there is going to cause a massive increase in prices. And right now where we're seeing it is in this below $150,000 market. So if there's any point in the next year that you want to be a real estate investor, you've got to do it now. You cannot wait. My prediction is by 2021, this number is going to be dropped in half. Like there will be no properties under 150 grand. And the problem is that rents are not keeping pace with house values. So you're just not going to have very many cash flowing rental properties. Expect this number to drop by half in the next 12 months. All of us who are buy and hold long-term real estate investors for the city of Houston is going to be essentially closed in 18 months. Houston Metro and Dallas, there will be very few rental properties available. So let's talk about, that's absolutely going to happen. There's a huge run up in prices. So let's talk about if and when there's a crash in the future. This is probably one of the best, and Darel, I would love to get your commentary on this since you are a lender. This is absolutely fantastic. Here's why we won't see a housing crisis after COVID-19. You guys can read through this article, but here's the most important chart. And Darel, I have only seen this published here. I would love to see somebody publish this. It's a little hard to read, but I'm going to explain to you what this is. This is mortgage originations, most of which are purchases, by credit score. The light blue is 760 plus. That's this top of the bar here. The dark blue is 720 to 759. This is the mortgage originations preceding the real estate crash. The crash really started about 2007. And if you just look at those colors, all you have to notice is what? This light blue gets bigger and bigger after the crash. The dark gray is kind of the same. It fluctuates a little bit, but it stays about the same. The light gray is shrinking. This, I don't know what you call this. This is like a mustard color. This mustard here is reduced dramatically, and this deep blue is it's infinitesimally small. What this tells me is the homeowners that have been borrowing money for the last 10 years, the vast majority of them have a 720 credit score or greater. That 720 credit score or greater starts right here at the bottom of this dark gray bar. That's like 70% of borrowers have a 720 credit score or better. This isn't like 2007, 2008 and before, where we're giving money to anybody that could fog a mirror. I mean, these borrowers are highly creditworthy. And most of the time, and Darel, maybe you can explain a little bit about this, when somebody's got a decent credit score, there's a high likelihood they got a little bit of money in the bank, they've got adequate reserves, they got a decent job. I would assume it's not always the case, but more than likely they've got a pretty good financial profile with a higher credit score.
Yeah, absolutely. And 760 plus, that number is huge. I've noticed looking at this graph here. 760 is a very high credit score.
It is in this
that's very high. Like 720 is considered really strong credit. You get over 760, I mean, you're in the upper echelon of credit. And so it's not like an everyday thing. I'm curious, I would like to see a graph with this, Jason, and show what the average credit score is of, working Americans. I would like to see that graph. Like what percentage would actually qualify?
Well, so here's I totally agree that we can actually pull it up and look at average credit score and some other stuff. But what's amazing? Well, you know what, Darel? Here's the problem with that, and you know this because you look at credit reports all day. If we go to Google and say, what's the average credit score? It's going to give the average FICO 8, FICO 9. It's not going to give you that FICO 245 score, the mortgage score, right? And those mortgage scores are typically much lower. So I would love to see that too. I mean, this is 760's got to be the what, top 7%, top 5% probably of Americans.
I would think 760 is high,
760's high.
Yeah.
I'll tell you one of my themes here today is the people who are buying homes now are not like the people who were buying homes before 2007. Like it's just a completely different class. In fact, although as much as I dislike this quote, it's absolutely true. If you guys remember when John Edwards was he was the vice presidential candidate running for office with John Kerry, he said there's two Americas, and everybody kind of blew him off. Well, in this case, he's right. In real estate, there's two Americas. There's the 720 credit score who's buying a house, and there's everybody below that who is virtually not buying a house. I mean, this quote recession we're in is a recession of the upper middle class and everybody else. And if you've got the six-figure job, a 720 credit score, and a little bit of money in the bank, you're doing just fine. If you're below that, you're filing for bankruptcy. I mean, the data is very clear. Like there's no middle ground. It's like you're either doing well or you're getting crushed. And Darel, I don't know how y'all's business is doing, but I can tell you for us and some of the other folks I've talked to over here the last couple of months, everybody's doing phenomenally well.
Oh yeah. Anybody in the mortgage business is doing really well because the rates have been so low. It's been crazy.
Yeah, it's absolutely insane, right? And if you're associated with real estate, you're doing absolutely phenomenal. Now, one of the other facts a lot of people don't know is real estate is what takes us out of recessions. And financing, the ability to refi or purchase a home with a lower rate mortgage is one of the things that drags us out of a lagging economy. So it's not any surprise to me that real estate's doing so well, which just tells me in next 18 to 24 months, it's just going to get better for us. But remind me, Darel, I'll shoot this over to you. You read the whole article. It's absolutely fascinating.
Yeah, send it to me, email it to me if you can.
I saw this and I was like, why am I not seeing this? So this is also one of my most favorite articles, just came out a couple weeks ago. This guy, Logan, is doing a phenomenal job over at Housing Wire that is really breaking down hey guys, there's no crash coming. Like, you know what I always find fascinating, and Darel, you've probably heard this, since 2008, there's always some, talking head on the news that's talking about the real estate crash this year. In fact, the joke Rob and I have, we go to YouTube and type in real estate crash in any random year, and there'll be 1,000 videos about how in 2016 there was going to be a real estate crash, in 2017 and 2010. I mean, it's like all these guys have. It's kind of like that whole proverbial, a broken clock's right twice a day. It's like these guys keep calling it and they keep getting it wrong. So I watch this stuff like a hawk because we borrow a lot of people's money. We've got a fund now. And so I've got to make sure that, hey, there's a time for us to go all in and buy as much as we can. And there's a time that we liquidate and play defense. It's good offense, defense. So I'm reading this stuff constantly. And one of the things I find absolutely fascinating is how wrong these guys have been. And Darel, you're going to love some of this because I've heard this for years now. For 8 years, we've been hearing this never-ending crash, right? You remember the silver tsunami crash? So this was mom and dad are downsizing, and because they are going to downsize, it's going to cause a crash on the higher end marketplace. Like they're going to move into condos and townhomes and all that stuff. That never ended up happening. There was no silver tsunami crash. My other favorite one was the investor supply crash. So you guys are familiar with Blackstone, American Homes for Rent, these really big hedge funds that went out and bought all this real estate, turned them into rental properties, and then they were going to turn around and liquidate all of their holdings, and that was going to cause a crash. Well, that never happened. There was an Airbnb supply crash. All these investors were buying Airbnbs. It wasn't going to work out. And then they were going to flood the market with Airbnbs. And Airbnb is an infinitesimally small percentage of the marketplace in most of the countries. So that never really made any sense. And then, of course, COVID-19 was surely going to crash the market 30 to 50%, despite the fact that zero underlying data out there has said that's the case. So I'm telling you guys, I'm just not seeing, I read this stuff every single day, and there's nothing out there that says there's going to be a crash. I want to talk a little bit about forbearances really quick, which is kind of interesting. So if you guys remember, as soon as the coronavirus stuff kicked off, you could then call your mortgage company and say, hey, I need to be put on some kind of forbearance plan. So a forbearance plan would stave off the potential for foreclosure and allow you to work out your loan. So here's a fascinating thing. A 30 to 50% crash in home prices next year would require that loans and forbearance go over 10 million. So when we saw in 2008, 2009, the real estate crash, we had at least 10 million houses in foreclosure. So this is assuming that we would have 10 million houses in forbearance that ultimately ended up in foreclosure. Here's what's fascinating, and this is some anecdotal evidence here. I know some folks that have gone into forbearance, and the reason they've gone into forbearance is because they're trying to renegotiate the terms on their loan to get a refinance without having to pay for it. So they're still paying their mortgages, but they're on like a 30-year fixed rate at 5.25%. And they're like, well, maybe I can go in for a forbearance and have them refi me at 3.25 or 3.5. There's a lot of people doing that. It's been surprising to see. Here's a fascinating thing. These loans, the loans in forbearance, have shrunk 18%. There's only 3 million that are in forbearance. In fact, at the peak, it was less than 5. So this whole idea that there's going to be this huge real estate crash and it's going to be like 2008 all over again just doesn't make any sense. And to go back to what Darel, what you and I were talking about, there's no loosey-goosey lending standards. It's not easy to get a loan these days.
No, it's not.
It's a ton of paperwork, right?
Yep.
And then you know this because you probably look at a lot of balance sheets with real estate on it. A lot of these people have a massive amount of equity. I mean, just it's not like it was in 03 through 06. There's not a lot of cash outs. There's folks that have a ton of equity. The at-risk loans are less than 3 million. I mean, I'm just not seeing this huge crash in real estate.
I'm not seeing it either because I don't have any delinquencies right now. I have not had any foreclosures this year. And I spoke to 2 different hard money lenders yesterday, and both of them said the same thing. Their portfolios are pretty much current.
Which is absolutely wild. I mean, you think about it. This was, quote, the recession. By the way, guys, we had a recession, and by the time you finished Tiger King on Netflix, it was over. I mean, it was like,
yeah,
it was that quick. Now, if you're watching the bankruptcy reports and the job loss reports, it looks very bad. But when you start to dig into a lot of those companies, they were terrible companies before the crisis. A lot of international companies, even national companies, are using coronavirus as an excuse to file for bankruptcy. I mean, I saw California Pizza Kitchen filed for BK last week. So it's like they just had too much debt. They were just way too highly leveraged.
And a lot of the retailers that were already in trouble.
Oh yeah, those retailers were. I mean, I've been surprised how long JCPenney's has hung on. I mean, they've got massive debt. Nobody shops there. It's like, It doesn't make any sense.
Yeah.
So here is a little bit of proof in the pudding that the 30-year fixed rate mortgage and real estate is really what drives recovery out of recessions. This goes all the way back to 1970. Point of fact, I was born in between here. So whenever I talk to these old-timer real estate guys, they're always telling me like, well, Jason, I remember when I used to buy my rental properties at 18% interest. And you never know, it could happen again. And I'm like, hey, man, I was born a few years before that happened, and it has not happened in almost 40 years. I'm not going to see 10, 12, 18% interest rates most likely in my lifetime. In fact, if you see this, these gray lines are recessions. Every time there's a recession, cut rates. Every time there's a recession, cut the rates, cut the rates, cut the rates, cut the rates. And it really moves the economy out of that recession when folks have a little bit more free cash. I'll share this with you, and then I'll zip over to a couple more articles, and then I'll finish up with you guys. I really like this one, Darel. The blue is outstanding mortgage debt. The green is home equity. I mean, we just have a massive, massive amount of home equity. It's 2/3. I think in this article somewhere, here it is right here. Also remember that 20 to 30% of all homes bought in the previous expansion were bought with cash. We are in a much better place now in the United States than we have been in the past couple of years. Home purchase demand still strong, but is slowing down. I think obviously it's October. We're going to see that natural slowdown a little bit. Let me see if I've got, here we go. We're seeing some interesting things happen in the multifamily space. I own some small multifamily out there. I don't currently negotiating on my first greater than 50 unit. I'll just say that. We're hoping to have that under contract by the end of the year. But it's very interesting to see what's going on in the multifamily space. You can see here where construction was down. I think that is eventually going to pick up. But I will tell you this, guys, I would just be very hesitant when you hear somebody come out as, quote, an expert on real estate, say, oh, well, the world's going to crash and all that. I'll give you a best example of that. We bought an office building in the middle of the coronavirus, and everybody told me that was going to be a big mistake. And right now we're sitting at about 65, 70% occupancy. We expect to be 100% occupied by the end of the year. And we're not even allowed to host any events or do anything cool. Like, people are just coming here. So I would be very hesitant to listen to a lot of these experts. And again, I'll just wrap this up, and then I'll be happy to take comments or questions. If you are considering getting into real estate, keep this in mind. Houses below $150,000 are going to be the bread and butter of your portfolio, and they are shrinking rapidly. Here in the HAR report, I'll just highlight this last number. Single family median sales price is up 8.3%. Said a better way, that's 9% a year in appreciation. Now, houses below the median home price, below this $265,000, are appreciating almost double. They're appreciating at 15% a year. They're appreciating more than a hard money loan. And I don't see that ending in the next 2 or 3 years. Again, below the median home price, below this $265,000. This is a dinosaur. There are virtually no builders who can build a brand new house for $265,000. That's another thing that's really driving these numbers. So if you're going to get into real estate, guys, I highly recommend that you do it right now. So I'm going to turn the screen share off, and I'll take any comments or questions you guys have. Opening up the chat here. Let's see what you guys got. Great info. You're welcome. Let's see here. This guy's talking about purchasing a vacation rental in Galveston. You know, I do know a little bit about Galveston. I would be very, 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 very hesitant to get into Galveston. I own a bunch of beach houses in Surfside. I own 6, 7, and I'm closing 2 more here in the next couple of days. I'll own 8 beach houses in Surfside. And what you'll find is that the rents are much higher in Surfside than they are in Galveston to offset the cost of flood insurance. Why should we get into real estate now? If you do not real estate, let's talk about real estate investing. If you're in buy and hold, if you are going to be a buy and hold real estate investor, you have to get in now. If you're going to buy real estate in a major metro area, Houston, DFW, you get in now because the asset's cash flow now. Do you know why nobody buys property in Austin? Because it doesn't cash flow. So
Very
Houston
true.
and Dallas, Fort Worth are going to end up in that. Yeah, you lend there, right? I mean, what are you lending on in Austin? It's all flips, isn't it?
Yeah, mostly flips. We don't do a ton in Austin, but we do a deal. We do a few deals there from time to time. But you're right, it doesn't cash flow in Austin. Um, you know, it properties cash flow in Houston. Properties can cash flow in Dallas. A little bit tougher in Dallas as well. San Antonio, I think, is a good market for rentals.
Yeah, I think you've got Houston, Dallas, Fort Worth. Austin's already closed for landlords. Houston, Dallas, Fort Worth. Uh, that game is going to be over in 18 months because the appreciation's so rapid. San Antonio's probably got 3 years. And one of the reasons we're in Corpus Christi because we're thinking that's going to be about a 4-year play. But I can show you guys the data. We bought stuff in Nueces County. We bought stuff all around Corpus. That market is up 23% year over year. And that's at the median home price. The median home prices in Corpus Christi is almost as high as it is in Houston. So these markets, these good metro markets, are closing rapidly. Let's see.
A lot of investors investing in Beaumont as well in that whole area. A lot of good cash flowing properties there.
Oh yeah, it's Beaumont, it's Lake Jack. Like Beaumont will be the place, right? Because you won't be able to buy any cash flowing stuff in Houston.
Yep.
So you're going to be in Beaumont, you're going to be in Lake Jackson, you're going to be maybe as far as Victoria, you'll be in Crosby, you'll be what's up off of 290, maybe Prairie View, Hempstead, further north of that. But you will not be in the Houston. You will not be inside of 99. That's probably the best way to put it.
Yeah, probably so. Someone's asking about the Dallas-Fort Worth market. Any inputs or comments in the booming area of Dallas-Fort Worth? Jose's asking this. I mean, Dallas-Fort Worth's a great market. It's been taking off like crazy, appreciating the last several years.
I think DFW's in the same place Houston is. You got 18 months.
Yeah.
And then you won't be buying any rentals there. I personally don't like Dallas because the Cowboys suck, but I really do like Fort Worth. I really like that town. But they're both great real estate markets. The reality is they're great real estate markets because everyone's moving here. Like,
yep.
Do you think Elon Musk is the only rich guy that didn't sit there in California and go, you know what, guys, this is terrible. I'm moving to Austin. I mean, he's selling all of his houses in Hollywood. Joe Rogan moved here. A handful of other guys that have moved here. And they're not the only rich guys that are going to move their business into Texas. And it's going to drive home prices through the roof.
Yep.
Steven says, what do you see happening 3 to 5 years in real estate? How do we as real estate investors make money? I don't really consider flipping a real estate investing. I'm talking specifically for long-term buy and holds. You'll still be able to do flips. Where I think this goes next, and Rob, my business partner, could actually speak to this better than I can, is you're going to see flips are going to be all additions. And that's what it's going to be, additions and ground up. Once we breach that $250, $300 a square foot threshold, you're going to start to see a lot of additions, that sort of stuff. It won't be the, hey, we're going to Meyerland and we're, rehabbing it, put 50 grand into it, we're going to make 40. I mean, that'll be kind of gone by then. Let's see here. Somebody already mentioned, hey, do you see other outlying markets that'll be great, like Lake Jackson? Yeah, all the markets around Houston are going to be fantastic. You're just not going to be buying in Houston proper.
Yeah, I think Lake Jackson's a good market to buy in. Someone's asking that. Galveston, I haven't done much in Galveston either.
Man, when you get off that seawall, the insurance just gets incredibly expensive.
Yeah, anytime you're in an area like that, which I'm surprised you buy in Surfside because of that, but I guess the cash flow is still there.
The cash flow's there, and the stuff we're buying is actually relative. We're buying everything under $200,000.
Okay.
So it's kind of crazy. We're buying, I bought a 500 square foot house for 10 grand more than what the lot next door sold for. So a lot of times for the stuff that we have to rehab, we're in for less than for a little bit more than lot value. We're really in for the rehab costs. But I'll tell you, the other thing that's going on at Surfside, Darel, is that market's appreciating 30% a year. What we're finding is Americans, in particular in South Texas and Texans, have figured out that, hey, we're probably not going to take that trip to Europe we've always wanted to take. Right? Our international vacation just got canceled for the next 3 years. So why don't we go buy a beach house? And it's driving up the price in some of those submarkets. Let's see. You recommended cash flow for starting in real estate or flipping. Don't got much, but I know my dad can help me getting money to do buy and fix, but not sure. if I should flip it or rent it. I will tell you, Darel, I'd love to get your take on this. Flipping houses is hard. Wholesaling is the hardest thing to do in real estate. I'll tell you that. Flipping is probably the second. Being a landlord, as long as you can get it rehab and refied, it's like a 2 or 3 year flip. Just close on it, sit on it, wait for the equity, then sell it. I'd love to get your commentary on that, Darren. It always seems like being a landlord's much easier than flipping a wholesale.
Yeah, flipping's not easy. Wholesaling is hyper competitive. I mean, you can make money doing it, but it's very, very competitive, and you have to be able to spend a lot of money to make money. And flipping is not easy. It can be done, but you have to be careful. You have to know exactly what you're doing, and it's not an easy. I was just talking to. I'm in physical therapy right now for my leg. I was talking to my physical therapist about it, and she's like, "Yeah, everybody seems like they want to flip." And I said, "Yes, but it's not as easy as it looks." So you can do that. I think I think he said he was younger, so he's looking to maybe build some capital, and that's not a bad way to build capital. You just have to be very careful, educate yourself, align yourself with the right contractors, and you can start making a little bit of money here and there and build a portfolio. That way, maybe you can start investing long-term in real estate, like Jason alludes to.
Sam said, "Hey, what is your fund target?" Our target actually is single family. It's 4 units and below, and we buy in Houston and in Corpus Christi. If you want to know more, I can give you our website. It's mrtxre.com, and it's on there. It's called the American Recovery Fund. Let's see. Hold on one second. I lost mine. Tara said, "Yeah, I never said Lake Jackson. I said Galveston Beachview." And I'm telling you, be very careful in Galveston. Galveston is a very tricky market. I mean, you go a half a block one direction, and I do own some property in Galveston, but again, if I got a choice between Galveston and Surfside, I'm buying at Surfside. Now, the asset I bought in Galveston, I bought 4 units in Galveston for 150, 160, and I put another 80 into it for 4 units. One's a duplex, 2 single family. I mean, I got it so cheap, I couldn't say no. But if I hadn't gotten something that cheap, I wouldn't have done it.
Are those all long-term rentals, Jason?
One we actually converted to an Airbnb, and the other 2 are long-term rentals.
Okay.
Any recommendations for a recent graduate who just started a new job in August, making $56 a year? I want to enter the real estate market, but do not have much saved. Make sure your credit is good and save absolutely as much as humanly possible. I will say this, for a lot of you guys that are listening, I would highly recommend, if you do not have your single family residence you want to live in, I highly recommend you get that sorted out this year, because they're getting horrendously expensive. I've got a house in the Heights. I live in the Heights now. It's okay. I just bought a place in Spring Branch, and we're about to start a rehab on. And it is amazing to me how much that stuff has appreciated in the last 6 months. So if you want an affordable house in a really nice area of town, buy it now. Don't wait. It's getting, like I said, it's getting really expensive. Have you done any new builds? Yes, we have, but not here in Houston. Any tips on how to enter the real estate area? No prior experience other than my dad's few rentals he has. I'd say go to the real estate events. Well, I guess you can't really go, right? You got to attend them. And then I'm a big fan of when folks want to get into real estate, if they want to have a more active role, I keep telling people, go get your real estate license. If you want to kind of do this as like a little side hustle thing, go get your real estate license and then tell everybody you know that you're a realtor. And if you do this long enough, somebody's going to give you a good deal. So that's kind of how I recommend people get started. I don't recommend doing what I did and quitting my job and all that. Most people just don't have the fortitude to do that. It's tough. It's really tough.
And I would say to that same gentleman, educate yourself. There's so much free education online. Go to Bigger Pockets. Bigger Pockets is a great website where you can learn a lot. And then maybe you can partner with somebody. You know, if you educate yourself, you find someone, whether it's a family member or a friend who maybe has a little bit of money, maybe you can partner with them. That's a good way to get involved.
We do a daily radio show now. So if you guys find us on YouTube, we do that every day. And 9 times out of 10, we're not talking about real estate. We're talking about Teslas or the election or something, but we occasionally do a little bit of real estate in there, and there's some good stuff there. Any tips on finding contractors? I wouldn't find contractors. I'd go find a general contractor. Fast Track is really good.
Fast Track's great for beginners because they'll do everything. You don't have to babysit them.
Yeah, Fast Track is great. You don't pay that much of a premium over other folks. If you guys know Joe over at Details, he's another one that's pretty good. I don't know if is Brant still does he still have Invest Home Pro? Is he still Rehab?
I don't know. I don't think so. I haven't seen anything, but I have no idea. I know he's doing more of the EXP Realtor stuff right now.
Yeah. So if Brant Phillips is still doing Invest Home Pro, he's another one that's really good. What's your YouTube? It's the Texas Real Estate Radio Network. So that's our daily show, if you will, Texas Real Estate Radio Network. So, well, Darel, I don't see any other questions. You see anything?
I don't see anything either. Thank you for sharing, Jason. Always, I know you're a data guy. It's always good to see your data. Send me that article when you can too. Also,
Yeah,
I'd like to see it. Someone's saying Darel Luter early on 2021. Don was like unknowns. Yeah, I mean, I'm a little bit worried about next year. And Jason, you give me your take on this. You said there's no real estate crash. I'm not saying there's a crash, but I'm worried about the economy because, in my opinion, this year has been heavily fueled with artificial money coming from the government. Mm-hmm. Pumping millions and millions of dollars into small business just to keep them afloat and to keep their employees engaged. And at one point it made more sense for a lot of people to quit their jobs and get unemployment because they'd be making more money. And so, it's an election year right now, so that all that's is gonna stay the course until 2021. So I'm curious how 2021 shapes up because I think a lot of that money is going to dry up, and so we still have a high unemployment rate. I'm curious what's going to happen then. They can't just keep this up forever,
So here's what's interesting. This is shadow stats, and so this is what's known as M1 and M2 money supply. So let me just set the stage. We're going to have to talk a little bit about politics, and it's going to make people uncomfortable, but it doesn't matter because this is very much an adult conversation. Despite the fact that everybody believes President Trump is conservative or Congress and Senate has conservatives in it, that is absolutely not true. They printed $12 trillion. $12 trillion. We only spent over 10 years from the last financial crisis. They only spent $4 trillion. So they printed 3 times as much money in 6 months.
Yep.
This is what it looks like. It's absolutely insane. So here's one of the things I know. If you talk to an economist, and Dr. Dotzauer is a good example, and he completely disagrees with me on this point, but I believe I got the data on my side. I mean, far be it for me to, argue with a guy who used to be the chair of the Texas Real Estate Center, right? And he says, look, Jason, there's no inflation. And I'll say, yeah, there is. It shows up in 4 places: automobiles, higher education, healthcare, and real estate. If you look at those 4 key metrics, inflation has run rampant. So here's what I know. 12 trillion got printed by the US government. That money, I can tell you right now, Darel, 90% of it hasn't even made it into the real economy yet. I mean, you can see it right here. The year-over-year change, this is a year-over-year change, is only 20%. So most of the money hasn't even hit the economy yet.
Yeah.
When it does, that money's going to show up in one of 4 places. It's going to show up in cars. It's going to show up in healthcare, higher education, and real estate. And I will agree with you. Commercial real estate has been in some pain for a little while now, about 12 months now, and it's about to get worse for those guys.
Yeah, retail and downtown office buildings are.
Oh, yeah, absolutely.
I mean, have you been to downtown? The downtown is empty.
Oh, I know. It's crazy to me.
They can't get people up the elevators because they want distancing. And so you're talking about going up 30, 40 stories. You can't get people efficiently up and down the elevator. So that whole downtown is just completely dead.
Look at, think of all of the commercial real estate that supports the airline industry.
Yep.
I mean, they're down 90% year to date, and they're not expected to recover for almost 5 years. So any of the stuff that's associated with that, it's going to be bad. But little tiny office buildings like what we got here, and we're under contract to buy a self-storage facility. To buy this little self-storage facility, we're paying nothing for it. I don't see a crash in that. But
Yeah, I think anytime you're doing with Class B or C properties, you're going to be okay. I think you can, you can maneuver that market. Courtney wanted me to remind you to email us all the resources that you use, Jason, and also to share your information on the chat here in case anybody needs it. I think you already did that though. Yeah.
Well, you know, the unemployment, it's not, I mean, go back and look at your borrowers. The unemployment is not your borrowers. It's not guys like us. It's the folks that, quite honestly, were at risk before. That's where, if you see a recession anywhere, I think that's where it's going to occur. And then one thing that's great, we live in Houston. Houston is counter-cyclical. I mean, Darel, you know, the other thing that's crazy is oil's been $40 a barrel for how long now?
Yeah.
I mean,
long time.
And I'll tell you what, even though this coronavirus thing is ravaging the countryside, our medical center is in a recession. Like coronavirus, a lot of people don't know this. COVID is destroying our healthcare system right now. Like how hospitals make money is surgeries. And there's virtually none that are happening. I mean, there are, don't get me wrong, but there's no money made. The only money in a hospital is really made in the OR. Cancer treatment's way down because no one's going to their appointments. So we are in the middle, and Houston's in the middle of a energy recession and a healthcare recession, which are the two big drivers of our economy. So when you talk about this 12 trillion finally hitting the marketplace and all of these folks who are in the middle of this personal recession that ends, I think the market's going to get really, really hot. But that's just kind of my thought, my take. I mean, hell, there could be a huge resurgence of coronavirus stuff and they could shut the country down again for another 6 months, which would be horrific. I don't think that's going to be the case.
I hope not. I've been reading about keep talking about this big surge that's coming in cases. So hopefully that won't happen because that would be catastrophic.
You know what's interesting about the surge, because we're seeing the surge now, and I'll tell you what's good about the surge. For the most part, people are wearing their masks. Now, don't get me wrong, everybody's going to go on here and say masks don't keep you from getting infected. And I think most Americans, in part because the administration did such a bad job communicating this, the mask doesn't keep you from getting coronavirus. It keeps you from getting a higher inoculum, a higher viral load. So when you do get the infection, it's much less severe. And then the second thing is the treatment is so much better than it was 8 months ago. You know, you go to the hospital, it's not a death sentence, right? I mean, you're actually going to live. And they know not to put you on a ventilator. So we're going to see a spike in cases, but I don't think it's going to be the bloodbath like we saw in the early days of the virus. I don't think it's going to be that bad.
Yeah, I think everybody's a lot more educated about it, and we'll be able to handle it a lot better. So anyway, I think we better shut this down. Everybody else got to get back to work. Jason, thank you again for joining us and sharing your insight and always your data that you love to keep up on. Always good information. Anybody has any more questions, you're welcome to email me at askdarel@noblemortgage.com. And please go to our website, noblemortgage.com/events to pay attention to our next one coming up. I believe next week we have a networking event. But thank you guys for joining us. See you guys soon. And Jason, thank you again, my friend.
Yeah, thank you so much for having me on.
All right, bud. Take care.